Today is Wednesday, the 11th February, and what I'm about to show you could completely change how you look at the silver market. Stop scrolling, give me the next few minutes, because this is not hype, not rumors, and not recycled headlines. This is hard supply and demand data, and it points to a serious imbalance building inside the silver market right now. Most people watching financial news will never hear this explained clearly, not because it's secret, but because it's buried in long reports that almost nobody reads line by line. Today, we're breaking it down in plain English. And if you care about protecting your money, your purchasing power, and your future, this matters. Welcome to Market Signals, where we cut through the noise and focus on what actually moves markets. Before we go deeper, I want you to do one quick thing. Comment your country and city below. I read the comments daily, and it helps us see what's really happening on the ground. Dealer premiums, coin shortages, delivery delays, real signals, not headlines. Now let's get into it. The latest silver market outlook shows something very important. The silver market is projected to run in a supply deficit again, and not just for 1 year. This would mark 6 straight years where global demand for silver is higher than global supply. Think about that. For 6 years in a row, the world has been using more silver than it produces. That gap does not magically fix itself. When demand is higher than supply, the difference is filled by pulling metal out of existing inventories, vaults, reserves, stored bullion. But those stockpiles are not unlimited. Every year of deficit makes the cushion thinner. For the current forecast year, the expected shortfall is around tens of millions of ounces. That is not a small number. That is not a rounding error. That is a structural gap. And structural gaps eventually force price adjustments. Let's make this simple. Global silver supply is projected to be a little over 1 billion ounces. Sounds big, right? But total demand is projected to be even higher. That means the market must again pull metal from stored inventory to balance transactions. Now stack that over multiple years, and you get a steady drain. This is like spending more money than you earn every year and covering the difference from savings. It works, until savings run low. That is why long-term investors are watching this closely. If you're finding this breakdown useful so far, hit the like button now. It helps this video reach more serious investors and tells the platform you want more data-driven market analysis, not just entertainment clips. Now let's talk about demand, because this is where the story gets stronger. Silver demand comes from 3 main areas: investment, industry, jewelry, and silverware. Investment demand is expected to rise strongly. After a few softer years, physical buying is increasing again. More investors are adding coins, bars, and silver-backed products to their portfolios. Why? Because uncertainty is rising. Currency concerns are rising. Market volatility is rising. And when uncertainty rises, hard assets get attention. Silver often benefits after gold starts moving, because investors see it as a more affordable entry point into precious metals. Industrial demand is the second major pillar, and this one is powerful. Silver is not just money metal, it is an industrial metal. It is used in solar panels, electronics, electric vehicles, data centers, AI hardware, 5G infrastructure, medical technology, defense systems. Even if some manufacturers reduce silver per unit through efficiency, total usage stays high because production volumes keep growing. More data centers, more chips, more electrification, more advanced electronics. That means steady silver consumption. Industrial demand is not emotional. It is functional. It is based on need, not price charts. Now, yes, jewelry and silverware demand is expected to soften at higher prices. That is normal. When prices rise, decorative buying slows. But here's the key point. Even with weaker jewelry demand, the total market still shows a deficit. That tells you investment and industrial demand are carrying the weight. Let's talk supply, because this is where many people misunderstand silver. Silver is mostly not mined by itself. Around 70% of silver comes as a byproduct of mining other metals like copper, lead, zinc, and gold. That means silver production does not quickly respond to silver prices. If silver doubles in price, miners cannot instantly double production because they are mining for other metals first. New mines take years to develop. Permits take time. Financing takes time. Construction takes time. So supply reacts slowly. Slow supply plus strong demand equals pressure. There is also rising recycling supply, people selling old silver items for melt when prices are high. That helps, but recycling is price-driven and inconsistent. It follows price, it doesn't lead it. Even with increased recycling, the market is still projected to remain in deficit. That is important. Now let's address volatility, because I know many viewers feel shaken by recent price swings. We've seen sharp moves up and down in both gold and silver. Big daily percentage changes, fast reversals, sudden drops, quick rebounds. Short-term traders hate this, but long-term structural investors often expect this during transition periods. Volatility usually rises when markets are repricing risk and adjusting to new realities. Calm markets happen when everyone agrees. Volatile markets happen when old pricing models are being challenged. So ask yourself, are you trading short-term moves or are you studying long-term fundamentals? Two very different strategies. Another factor getting attention is tight physical liquidity in major trading hubs. When reports mention tightness in physical markets, it means available deliverable metal is not abundant at current prices. That does not mean no silver exists. It means available silver at current trading levels is limited. And when availability tightens, price sensitivity increases. Now I want your view. After the recent volatility, are you more confident in precious metals or less confident? Write one word in the comments, more or less, and tell me why. I read these responses carefully because Market Crux is built around informed discussion, not blind agreement. Let's zoom out to macro conditions. Precious metals tend to benefit from geopolitical tension, currency uncertainty, policy instability, central bank credibility questions, inflation concerns, market risk cycles. Right now, several of these factors are active at the same time. That creates a supportive backdrop for hard assets, even if the path is not smooth. Remember, markets do not move in straight lines, they move in waves. Another important point, large silver investment products still hold massive amounts of metal on behalf of investors. Despite inflows and outflows during volatile weeks, total holdings remain historically elevated. That suggests long-term interest has not disappeared. It suggests positioning, not panic. Here is the simple framework I want you to remember. We have multiple years of supply deficit. We have steady industrial demand. We have recovering investment demand. We have slow supply response. We have tightening physical availability signals. We have supportive macro uncertainty. When many indicators point in the same direction, smart investors pay attention, even if timing stays uncertain. Because timing is always uncertain. Direction is what fundamentals help with. If you want clear, data-focused breakdowns like this, not hype, not fear, make sure you are subscribed to Market Signals right now. Subscribe and turn on notifications so you don't miss upcoming market deep dives. We focus on evidence, reports, numbers, and real trends, explained simply. And here's a stronger action for you. Share this video with one person who follows markets but only watches headlines. Help them see the underlying data, not just price moves. That's how smarter investor communities grow. Before we wrap, I want your price outlook. Where do you see silver by the end of next year? Drop your number in the comments. No essays needed, just your target and one reason behind it. Different views are welcome. Debate is welcome. That's how we sharpen analysis here at Market Crux. Mainstream coverage will keep calling precious metals too volatile and too risky. But volatility is not always danger. Sometimes it is transition. The real risk is ignoring structural data. 6 years of deficits matter. Inventory drawdowns matter. Industrial demand trends matter. The numbers matter. And here at Market Signals, we follow the numbers. Thanks for watching. Hit like if this helped you. Subscribe for more market truth. And I'll see you in the next analysis.